There are many basic things that you should know when it comes to how to apply for a loan. When applying for a loan, you need to be certain that you know the requirements that are set out by the lending institution. The lender may have different loan requirements from one lender to another, so it is essential that you do some research before you apply. What is not so common knowledge, however, is that you can get a loan even if you have bad credit. It does not matter what kind of credit history you have because lenders are looking for certain characteristics. Your age, length of time in the country and the state you live in all play a part in the application process. You do not need bad credit to apply for a loan, as long as you meet the requirements and have a good credit rating. Many people prefer to take out a secured loan instead of an unsecured loan because of the advantages that they offer. A secured loan means that the interest rate on the loan is capped at a certain level. Most lenders who offer secured loans will give you a higher interest rate if you have good credit and are getting them a secured loan rather than an unsecured loan. An unsecured loan allows you to borrow money for any reason without the need for collateral. This allows you to borrow any amount up to a certain limit, and it is important that you only borrow what you can afford. If you have an existing loan that is set to be paid off in a year or two, then you can borrow more than you can afford and then pay off the rest of the loan. However, you should do your homework and make sure that you are only borrowing what you can afford. Any money that you are not spending on a daily basis can put you in a worse position than if you had only borrowed the amount you could afford. Your credit history will play a major role in this decision. It is often cheaper to take out a loan on a monthly basis, and this is the option that you should consider. A loan that is taken out on a monthly basis means that you will have to repay the loan when you draw the next payment. This is a good option if you are planning to use the loan to purchase something. It is also better to pay off the loan on a monthly basis and then draw the next payment than to keep paying it every day. When paying off the loan on a monthly basis, the interest rate will go down, and this will be better for you because you will save money on interest. You do not need to repay the entire loan amount each month, just the interest, and this is called a grace period. A grace period is taken away once the borrower's debt has exceeded their equity, and this is typically set at 2 years. Some lenders allow borrowers to extend this period. It is possible for you to take out a mortgage loan over a number of years if you can pay on the loan, and you can continue to extend the grace period and the loan limit. You can look into several types of loans. This is good news because lenders will want to know about the amount of money you have available for spending. These loans can include payday loans, car finance, and even debt consolidation loans. Getting a loan is very easy to do, and there are lenders willing to lend you money. However, you need to ensure that you have the money to repay the loan, and you must also be able to repay the loan in a short amount of time. You should only take out a loan if you can afford to pay the loan back. Ensure that you compare quotes from a number of financial institutions before choosing the one that will suit you best. Being prepared will help you avoid problems down the road.